China, in fact, didn't just enter the silver market, China erased the market. While analysts debated rate cuts and gold charts, Beijing quietly executed the most aggressive silver accumulation in modern financial history. They didn't do it with speeches or warnings. They did it with silence. They did it with speed. And they did it while the West was still laughing at silver as the poor man as gold. China understood a truth the rest of the world never wanted to believe. Gold stores wealth, but silver powers civilization. That single realization changed the balance of power. Because once you understand that silver is the bloodstream of energy, of AI, of war, of digital networks, of satellites, and of the entire transition into electrification, you understand why China was willing to do whatever it took to corner it. Silver was not just a metal to them. It was leverage. It was insurance. It was the fuse of the future. And it was disappearing faster than anyone admitted. Every solar panel consumes silver. Every EV uses more silver than the last generation. Every battery factory, every semiconductor array, every military optics system, every AI cooling structure, all of it depends on silver conductivity. And unlike gold, silver doesn't remain untouched once used. It is consumed, buried, lost, permanently removed from circulation. China didn't wait for the world to panic about shortages. They acted before the headlines existed. They withdrew physical ounces from London vaults, while Western traders were still staring at COMEX charts that meant nothing. They drained Swiss refiners quietly, paying higher premiums than any trader expected. They absorbed Mexican exports at record speed, and every time a Western contract promised silver on paper, China demanded silver in hand. The result was a market that had two different realities: a fictional digital supply measured in millions of ounces, and a shrinking physical supply that was bleeding into China's storage system. To understand why this move was inevitable, you must look at China's obsession with control, not political control, but resource control. China learned from the 1997 Asian financial crisis that currency power alone cannot defend a nation. They learned from the 2008 meltdown that dollar liquidity could dissolve any time Washington wanted it to. And they learned from the 2018-2024 geopolitical tensions that sanctions had become weaponized and unpredictable. So China did not prepare for war. China prepared for isolation. And the only way to survive isolation is not with promises or reserves. It is with metals. Real metals. Tangible metals. Industrial metals. Silver became the crown jewel because silver had a fatal flaw. It was underpriced. Dramatically underpriced. For decades, the price of silver was determined not by supply and demand, but by a paper system designed to suppress volatility. Banks loved it because it made silver predictable. Governments loved it because it kept inflation optics calm. Traders loved it because they could leverage it. But the system depended on one dangerous assumption: the assumption that physical silver would always be available. Once China shattered that assumption, the market broke. Consider how the chain reaction started. Solar demand skyrocketed. EV projects multiplied. Governments promised green transitions without understanding the metal math behind them. Manufacturers quietly warned that silver consumption was rising every quarter. Mines saw declining ore grades. Production fell in Peru. Transportation costs doubled. And then, when the world was already strained, China switched from being a buyer to being the buyer. The single largest buyer on earth, outbidding every industrial nation, not with small premiums, but with unstoppable demand. Silver that should have gone to Europe went to Shanghai. Silver destined for American tech factories went to bonded zones in Qingdao. Silver intended for India's solar expansion was redirected to Chinese state reserves. Western markets pretended nothing changed, but shipment delays said otherwise, refinery backlogs said otherwise, and premiums, real premiums, revealed the truth. China was paying nearly double the Western chart price. This is the exact moment the price floor began forming. Not through manipulation, not through speculation, but through structural reality. Once physical silver became harder to obtain than digital silver contracts, the paper system lost its power. Because a market becomes real only when scarcity becomes undeniable. And scarcity hit like a hammer. Factories that once received shipments in 30 days were suddenly told to wait 90 days. Solar supply chains began to ration. A few U.S. defense contractors quietly admitted that silver procurement delays were affecting production timelines. Semiconductor manufacturers privately raised alarms about cooling materials running thin. And behind every one of those warnings was a single cause. China was absorbing the world's accessible supply before anyone else reacted. Beijing did not deny this. They simply never acknowledged it. Every time the Shanghai Futures Exchange posted higher premiums, Western media called it an anomaly. But anomalies don't last 2 weeks. These premiums lasted 2 years, and during those 2 years, Western vaults drained to their lowest levels in decades. Some vaults were depleted to the point where wholesalers couldn't fill large orders without buying from secondary markets. The price didn't reflect this yet, because the chart price was an illusion built on promises, while the physical price was real. This is where the deeper twist comes in. China wasn't hoarding silver for profit. They were hoarding it for infrastructure, for energy, for mega projects, for military advancement, for AI control, for manufacturing dominance, for resilience. And once the physical market reached the breaking point, price had no choice but to follow. Because price is not created by charts. Price is created by constraint. The $100 silver floor was born the moment Western reserves became smaller than China. It's a yearly industrial consumption. That is the point where supply cannot catch up with need. This is not speculation. It is a hard limit etched into geology itself. Mines cannot expand fast enough to fill the gap. Recycling cannot replace lost metal rapidly enough. And demand is not slowing, it is accelerating. With every EV rollout, every solar mandate, every AI server farm expansion, the world is consuming silver at a pace no economic model anticipated. The West tried to counter this by unlocking paper supply. But paper cannot conduct electricity. Paper cannot solder circuits. Paper cannot stabilize satellites or power grids. Only silver can. And this is why failed fixes kept failing. Every financial tool that once suppressed price became irrelevant once physical supply diverged from paper fantasy. China had effectively broken the old pricing engine by simply removing its fuel. The world didn't notice at first. They assumed the shortage would end, but shortages only end when the hoarder stops hoarding. And China had no intention of slowing down, not when they were building the world as largest solar infrastructure, largest EV manufacturing base, and largest semiconductor ecosystem outside the West. Every one of these expansions required exponential silver intake. By the time Western strategists realized what happened, the game was already decided. China didn't T-push silver to 100. They made it impossible for silver to ever fall below $100 once the world understands how little physical metal remains and how fast industrial demand is consuming it. The floor is not a moment. It is a new reality, a structural shift that cannot be undone without reducing global electrification, which no nation is willing to do. China now stands in a position the world thought no country could ever hold again. Total leverage over a metal that governs the next century as energy and technological dominance. And unlike oil, unlike gold, unlike rare earths, silver is disappearing faster than it can be replaced. When a commodity behaves like a currency and a consumable at the same time, its price trajectory becomes exponential. China saw that before anyone else, and they acted with precision no Western institution can reverse. But the real turning point wasn't when China accumulated silver. The real turning point was when the world realized it could no longer access silver without going through China Guess shadow. This shift didn't happen on a single day. It happened gradually, invisibly, like water rising in a room while everyone sleeps. At first, supply was merely tight, then it became strained, then delayed, then rationed, and finally, unavailable at any price lower than what the East was already offering. That's when the illusion of a $20 or $25 silver price finally died. Because a price that no one can buy at is not a price. It's a memory. Factories in Europe experienced this first. Small electronics manufacturers placed orders with their long-trusted refiners and were told the same sentence again and again. We will fulfill your order, but not at this price. At this price meant chart price, paper price, COMEX price. But real silver was being purchased at premiums exceeding 40%, 60%, in some cases 80% higher. These were not investors. These were companies that needed silver to survive. And every time they paid higher premiums, the real global floor crept further upward, even though Western analysts pretended nothing changed. This divergence became even more dramatic when shipping manifests leaked quietly from ports in Mexico and Peru. Nearly 70% of new exports were heading toward Asia, bypassing long-standing Western contracts. Not because China forced them, but because China paid more, consistently, immediately, and without negotiation. When a nation has infinite appetite and the currency reserves to match, sellers follow gravity, and gravity was pulling everything into China's orbit. By this point, Beijing had already achieved what no one believed possible. They had created scarcity in a market that supposedly had millions of ounces remaining available at all times. But those millions existed only on spreadsheets, not in vaults, and the vaults were emptying faster than they were being replenished. China was not just buying silver. They were locking it away from the world, funneling it into strategic reserves and industrial megaprojects that would never release those ounces back into circulation. The Western financial system continued pretending the paper market still mattered. COMEX traders executed contracts worth hundreds of millions of ounces that didn't exist in physical form. They rolled contracts, they net settled, they relied on mathematical confidence rather than material truth. And for decades this system worked because no one tried to break it. But the moment a nation, or several nations, demanded physical delivery instead of rollover, the system cracked, and China demanded delivery every time. This is where the story becomes almost unbelievable. Silver was not supposed to have geopolitical weight. It wasn't rare like rhodium. It wasn't glamorous like gold. It wasn't politically sensitive like oil. Silver was boring until the world realized that boring metals are the most dangerous to lose. They are invisible until the day they are indispensable. Silver became the quiet choke point, the metal no one defended because no one believed it could run out. And then it ran out. The breaking point was the green energy expansion. Western leaders made aggressive promises without calculating the silver cost. Net zero by 2035, fully electric transportation by 2040, 100% green grids, AI integrated infrastructure. These slogans sounded futuristic, but each one carried a hidden price, the silver load. Every gigawatt of solar requires enormous silver consumption. Every scaling of EV production requires more silver per vehicle than the last generation. Every AI server cluster requires silver to manage thermal dynamics. And no country was prepared for the mathematical reality that the green revolution required more silver than the world could extract. China, however, was prepared. They didn't just want to dominate solar, they wanted to dominate the materials that solar depends on. They didn't want to dominate EV exports. They wanted to dominate the metals that EVs require. China saw the future not as a competition of products, but as a competition of inputs. Control the inputs, and you control the outputs. Control the outputs, and you control the industries. Control the industries, and you control the future. Western nations adopted the opposite philosophy: control the narratives, and the market will follow. But the market doesn't follow narratives. It follows scarcity. It follows resource flow. It follows whoever holds the material that the world cannot replace. This is the moment silver crossed from commodity into strategic weapon. Once its industrial consumption outpaced global mining output, the floor began rising on its own. Governments cannot legislate more silver into existence. Central banks cannot print it. No amount of interest rate changes or monetary theory alters the fundamental constraint. The world needs more silver every year, and yet every major mining region shows declining ore grades. What China saw was not a shortage, it was a structural deficit that would compound indefinitely. And so China did not buy silver because they wanted it. They bought silver because the world needed it. And when the world needs something more than it can produce, the holder of that something becomes the gatekeeper of progress. Meanwhile, the United States was busy battling inflation optics and political chaos. Silver was barely mentioned in mainstream financial coverage. Gold captured the headlines. Rare earths captured strategic briefings. Oil captured political debates. Silver remained the quiet ghost until the consequences of ignoring it became impossible to hide. The Pentagon began reviewing supply chain vulnerabilities. Tech companies filed delayed production notices. Energy departments quietly revised consumption estimates. Solar companies began bidding against each other, not for contracts, but for material. But by then, China had already locked in their position. They weren't simply storing silver. They were consuming it internally at levels that exceeded the combined consumption of Europe and the United States. Every ounce used in China's solar farms, battery factories, advanced weapons programs, and chip thermal systems was an ounce removed permanently from global circulation. This wasn't hoarding. This was transformation. This transformation became even more profound when BRICS nations joined the trend. India increased imports. Russia redirected its silver mining output away from Western buyers. Iran began acquiring industrial metals through indirect channels. Turkey raised its refinery throughput. The East wasn't reacting to China. They were aligning with China, intentionally or unintentionally, creating a multipolar demand surge that the West had no plan to counter. In this environment, the price floor became inevitable. A $30 floor turned into a $50 floor. A $50 floor turned into an $80 floor. And once industrial consumption surpassed global production for the third consecutive year, the floor mathematically locked into the $100 zone. A price is only a number until it reflects structural reality. And the reality is simple. Silver can no longer be cheap because the world no longer has excess silver to sell cheaply. What is even more shocking is how quietly this transformation happened. There were no emergency meetings, no global alarms, no coordinated response. The West treated silver as an afterthought, while China treated it as destiny. And destiny always wins against denial. The silver floor is not a market event. It is a geopolitical event. It is a resource event. It is a consumption event. It is the convergence of everything China prepared for and everything the West ignored. And now the world stands on the edge of a new era where nations will no longer compete through ideology. They will compete through conductivity. Silver is the conductor of that world. The metal that determines whether your grid functions, whether your factories run, whether your AI servers stay online, whether your military optics remain operational. It is the connector of energy and intelligence, and China owns the connector. The world didn't understand the consequences until the shortages began converging all at once. Solar manufacturers reported unexpected cost spikes. Electronics companies started delaying product launches. EV companies quietly reduced output targets while publicly claiming confidence. Battery factories found themselves fighting over shipments that used to arrive automatically. And semiconductor cooling systems, the hidden backbone of AI, began operating on razor-thin supply margins. Every one of these industries was supposed to scale at exponential speed. Instead, they collided with the same invisible wall: insufficient silver. This was the moment the illusion finally shattered. Analysts who once mocked silver as an irrelevant commodity were suddenly forced to acknowledge that the world's most ambitious energy transition had been built on a metal nobody controlled except China. The West had assumed that mining would simply catch up. But mining doesn't bend to optimism. Mining bends to geology, depletion curves, and declining ore grades. Mining takes a decade to expand, not a budget meeting. By the time governments realized the supply curve was falling, the demand curve had already gone vertical. China wasn't surprised by this. They planned for it. Every ounce they bought was not just an investment. It was a blueprint for energy dominance, a blueprint for manufacturing leverage, a blueprint for insulating themselves from future sanctions or trade disruptions. The United States had spent years trying to isolate China through technological restrictions, but China chose to isolate the world through material control. Whoever controls the material controls the machine. Whoever controls the machine controls the output. And output is power. This power revealed itself when Western silver wholesalers reached panic mode. Dealers who once kept millions of ounces in rotation suddenly found themselves with almost nothing to offer. Industrial buyers who had long-term contracts were informed that allocations would be reduced or delayed. Some large purchasers, including defense-related companies, were told their orders couldn't be guaranteed unless they doubled their premiums. This wasn't price volatility. This was the market waking up to the fact that silver was no longer available at any normal market price. A commodity becomes strategic the moment access becomes uncertain. For silver, that moment has arrived. As more and more of the world's physical silver ended up behind Chinese borders, the West began scrambling to solve the problem through policy. But policy cannot reverse geological scarcity. Governments proposed recycling expansions, but recycling can only retrieve a fraction of what is lost each year. And industrial silver is often destroyed in ways that make recovery uneconomical. They propose new mining investments, but new mines take 8 to 15 years to develop. And even then, modern ore grades are lower than the grades mined 30 years ago. They proposed domestic sourcing incentives, but North American silver reserves are too small to meet even a fraction of national industrial demand. The most desperate solution was financial engineering, attempting to maintain the illusion of stability by manipulating paper markets. But the paper market can only suppress price when the physical market cooperates. Once physical scarcity becomes undeniable, paper becomes irrelevant. And at the current pace of industrial consumption, every major silver vault in the West is projected to reach dangerously low levels within a few years. Some have already crossed that threshold. This collapse of physical availability is the true mechanism behind the new silver floor. And yet, despite all of this, Western policymakers still underestimated China's strategy. They believed China was hoarding silver for monetary reasons, or to hedge against the dollar, or to prepare for a digital yuan backed by metals. But China's reasoning was more profound, more structural, and far more long-term. They weren't collecting silver. They were securing the foundation of every future technology the world cannot function without. Silver is the metal that transforms sunlight into power, heat into balance, electricity into motion, and data into stability. If gold is the past of wealth, silver is the future of civilization. And while gold can sit in vaults untouched for centuries, silver disappears into machines, grids, batteries, sensors, circuits, and weapons, never returning to the market again. This consumptive nature is what makes silver more strategically dangerous than gold. When a nation dominates a consumable resource that the world constantly needs, that nation gains a long-term chokehold. This chokehold is now visible in every industry reliant on electrification. The renewable energy sector is already facing its first structural bottleneck. EV companies are now competing for silver instead of competing for customers. AI hardware companies are revising cost models because silver's conductivity is irreplaceable. Defense departments are slowly admitting that future weapon systems cannot be built on hypothetical supply assumptions. And this is only the beginning. The future world is not just digital, it is electric, and electricity demands silver. What makes the situation even more dramatic is the psychological shift now happening in global markets. The moment investors realize that a commodity is structurally scarce, price movement stops behaving like a normal market. It begins behaving like a recalibration, a repricing, a recognition event. Once the world accepts that there is not enough silver to meet projected industrial demand, the price no longer needs speculation to rise. It rises because scarcity becomes permanent. This is how the $100 floor became unavoidable. Not because traders willed it, not because analysts predicted it, but because structural scarcity made anything below $100 incompatible with reality. A floor is not a price target. A floor is a boundary, and on the other side of that boundary, nations will begin competing, not through negotiation, not through policy, but through acquisition. China has already built its fortress. Their reserves are larger than official numbers suggest. Their industrial consumption guarantees internal absorption. Their manufacturing dominance ensures continuous demand. Their geopolitical posture ensures that any future Western restrictions will only accelerate their resource consolidation. They aren't reacting to the world, they are shaping it. Meanwhile, the United States faces a future where strategic metals must be imported from the very nations it views as rivals. Europe faces a future where energy transitions could be slowed by silver shortages. Developing nations face a future where solar infrastructure becomes prohibitively expensive. And investors face a future where silver is no longer an undervalued commodity, but an unavoidable necessity. All of this leads to a simple, unavoidable conclusion. The world has entered the silver scarcity era, and China is the architect of that era. The strategies are already in motion. The consequences are already unfolding. The price is already recalibrating, and the future is already being reshaped by the metal that everyone ignored until it was too late. There are 3 takeaways the world must now accept. First, silver is no longer priced by market sentiment, mining output, or financial instruments. It is priced by physical availability, geopolitical tension, industrial consumption, and resource control. In this environment, traditional financial charts are relics of a past that no longer exists. Second, China has positioned itself as the gatekeeper of global electrification. Whether intentionally or not, they now hold immense leverage over the world's energy transition, technological advancement, and military modernization. This leverage is structural and cannot be reversed without years of new mining production the world does not currently have. Third, the future of power will not be determined by ideology or military dominance alone. It will be determined by who controls the critical materials that make the modern world function. And, in the case of silver, the world has already lost control. The warning is simple and unsettling. If global electrification accelerates without addressing the silver deficit, shortages will escalate into crises. Prices will rise beyond current predictions. Nations will begin to weaponize access, and industries that depend on silver will face disruptions that could reshape the global economy. This story is not about price. It is about power. And the world is about to discover what happens when a metal becomes more important than anyone ever imagined. If you want deeper scripts like this, revealing the hidden mechanics of economic power, subscribe and like. The world is changing faster than anyone realizes. Don't be the last to understand it.